What if the most important market signal right now isn't flashing on your screen, but sitting quietly in a bank account earning interest? Warren Buffett has stepped away from the day-to-day spotlight, and at the same time, Berkshire Hathaway is sitting on an enormous mountain of cash and short-term treasury bills, not a modest cushion, not routine liquidity, a sum so large that it rivals major institutions. And that raises a question that serious investors can't ignore. What is he waiting for? For several years now, Berkshire has been a net seller of stocks. Quarter after quarter, more shares have gone out the door than come in. That alone is unusual. Buffett built his reputation on patiently accumulating great businesses and holding them for decades. When someone with that philosophy starts trimming aggressively, it's not random. It suggests discipline meeting valuation. Take Apple. For years, it was the crown jewel of Berkshire's portfolio, at one point representing roughly half of its public equity holdings. Buffett has repeatedly praised the company and its leadership. Yet as valuations expanded and optimism surged, he reduced the position significantly. That doesn't necessarily signal a problem with Apple's business. It may simply reflect a price that moved beyond his comfort zone. Great company, different math. The same pattern has shown up in financial stocks like Bank of America. Buffett originally invested during a period of extreme stress, when terms were highly favorable and fear dominated headlines. As the cycle matured and valuations normalized, or perhaps stretched, he trimmed there too. Again, not a verdict on the institution, but possibly a reflection of changing risk-reward. Now zoom out. When Buffett accumulates large cash reserves, history tends to remember what came next. In the late 1960s, he wound down his partnership, saying he couldn't find bargains. A painful market decline followed in the early 1970s. In the late 1990s, he avoided the dot-com frenzy and endured criticism for being out of touch. When the bubble burst, his restraint looked less old-fashioned and more strategic. Before the financial crisis, he had dry powder ready. When liquidity vanished in 2008, he became the lender of last resort to companies that desperately needed capital. None of those episodes were about predicting a crash on a specific date. They were about probabilities. When valuations stretch far above historical norms, measured by metrics like market capitalization relative to GDP, price-to-earnings ratios, or price-to-book multiples, future returns tend to compress. Not immediately, not predictably, but eventually. Right now, parts of the market appear richly priced by historical standards. That doesn't mean an imminent collapse. Markets can stay expensive longer than most people expect. Momentum, innovation cycles, and liquidity conditions can keep valuations elevated for years. But from a long-term perspective, high starting valuations often imply more modest forward returns. What makes this moment fascinating is not just the size of Berkshire's cash pile, but where it's parked. Short-term US Treasury bills. Essentially, risk-free instruments offering yields that, in today's rate environment, are meaningfully positive. For the first time in over a decade, sitting in cash isn't synonymous with earning nothing. Patience is being paid. That changes the equation. In a near-zero rate world, holding cash carried a heavy opportunity cost. Today, it can generate substantial income while preserving optionality. Optionality is the key word. Cash is not just defensive, it is strategic flexibility. It allows decisive action when others are forced to sell. It's tempting to interpret all of this as a dramatic warning. But Buffett rarely operates in absolutes. He doesn't need the market to crash. He only needs better prices than today's. His approach has always been rooted in margin of safety. Buying when pessimism is high and stepping back when optimism feels euphoric. So perhaps the more useful question isn't, is a crash coming? It's, what are current prices assuming about the future? If expectations are already near perfection, even good outcomes can disappoint. If uncertainty rises, cash suddenly becomes powerful. Buffett may not be predicting the next downturn in words, but through his actions, he appears to be positioning for a world where patience, liquidity, and discipline matter more than chasing the last percentage point of upside. And in markets, sometimes what someone chooses not to own tells you more than what they do. There's a moment in every market cycle when the numbers stop feeling exciting and start feeling uncomfortable. This might be one of those moments. If you zoom out and look at broad valuation measures today, they're not just elevated, they're stretched compared to long-term history. One of the simplest gauges, total US stock market value relative to GDP, often called the Buffett indicator, has climbed to levels rarely seen before. Historically, that ratio has hovered much lower. It spiked during the dot-com era. It surged before the financial crisis. And today, depending on the exact methodology, it appears to be in that same rarefied air again. Now, that doesn't automatically mean a crash is imminent. Valuations are not timing tools. They're gravity. They tell you about long-term return potential, not what happens next Tuesday. But when market capitalization towers over the underlying economy that supports corporate earnings, it can suggest that expectations are doing a lot of heavy lifting. Another lens tells a similar story. The cyclically adjusted price-to-earnings ratio, popularized by Nobel laureate Robert Shiller, smooths earnings over a decade to account for booms and recessions. Over the long arc of history, it has tended to average in the high teens. Today, it sits far above that baseline. The only period that clearly exceeded current levels was the peak of the late 1990s tech bubble. Here's why that matters. When starting valuations are high, future long-term returns have historically been more modest. Not negative every time. Not disastrous by default, but muted. The math simply leaves less room for expansion. If you pay a premium for growth, that growth has to be exceptional and sustained for years to justify it. Of course, this isn't 1999. The companies leading today's market are enormously profitable, globally dominant, and deeply embedded in everyday life. Artificial intelligence, cloud infrastructure, and digital ecosystems are not fictional business models. The revenue is real, the cash flows are real. But valuation has always been about the relationship between price and fundamentals, not just the quality of the story. Even extraordinary companies can produce disappointing returns if purchased at extreme multiples. History is full of examples where great businesses were temporarily priced for perfection. When perfection proved slightly imperfect, investors paid the price. There's another subtle risk developing beneath the surface: concentration. A small group of mega-cap stocks now represents an unusually large share of major indices. That means many passive investors, those who believe they are broadly diversified, may actually be heavily exposed to a handful of names. If those leaders stumble, the impact could ripple across portfolios far more than people expect. And then there's the strategic layer. When corporate tax policy is relatively favorable, companies may choose to realize gains while rates are low rather than gamble on future changes. That kind of decision isn't emotional, it's arithmetic. Large-scale portfolio adjustments can reflect not just valuation concerns, but prudent tax management and balance sheet flexibility. Put all of this together, and a pattern begins to emerge. Holding significant cash in an environment where short-term government securities offer meaningful yields is no longer a penalty. It can be optionality. It's the ability to move decisively if volatility returns. It's the freedom to act when others are forced to react. Importantly, none of this requires predicting doom. Markets can remain elevated longer than skeptics imagine. Innovation cycles can justify higher multiples for extended periods. But when expectations are stretched, the margin for error narrows. The real takeaway isn't about panic, it's about perspective. High valuations don't demand drastic action. They invite thoughtful evaluation. They encourage investors to examine concentration, time horizon, and risk tolerance with clear eyes instead of momentum-driven optimism. The most seasoned capital allocators rarely try to forecast the exact turning point. Instead, they prepare for a range of outcomes. They recognize that protecting flexibility during euphoric phases can be just as important as being aggressive during fearful ones. Years from now, we may look back at this period as another chapter in a long cycle of expansion and recalibration. The only question is whether we approached it with discipline or drifted along with the crowd. In markets, being prepared often matters more than being perfectly right.